With us now, Dr. Olaf Groth. He is a global strategist, faculty at the UC Berkeley Haas School of Business, and CEO of think tank Cambrian AI. Thanks for being here.
Thanks for having me, Carly. It's always fun.
Let's start with stocks. It's been a roller coaster ride on Wall Street lately. What's going on?
It's been crazy, right? I think we're just about a percentage point away or so from a bear market, which is a 20% drop. So we've already exceeded that, of course, with the NASDAQ at about 29%. So I think, the markets are taking account of uncertainty. They're very jittery because we're at risk of sliding into what's called stagflation. Stagflation is the combination, as the term says, of stagnation and inflation, right? So on one hand, we have prices getting ever more expensive and people having trouble affording them. And on the other hand, companies are posting lower earnings, which means they put out less stuff, they're making less revenue. And so we're being squeezed on both ends. That's a really bad situation to be in, which is why I'm expecting the Fed to be acting quite concertedly now. So that's essentially what's going on.
And now to cryptocurrency, the cryptocurrency crash. What's behind the sell-off, and do you think it'll recover?
Yeah, look, it's all interconnected, right? When there is jitters in the general economy and a sell-off, then of course the highest risk assets are always going first. And what we're seeing here is really one massive spring cleaning of crypto. There are crypto assets like Luna and Tether. They were pegged to each other in a rather doubtful peg that brought the whole construct down tumbling. And then there are more stable assets on the other end, like USDC, that are stable coins that are pegged to, or backed by, I should say, cash and bond offerings with very transparent reporting. DAI is another one of these stable coins that is doing rather well. And then there is a whole bunch of stuff in the middle, like Tether, that claims to be, backed by a combination of cash and equity and bonds, but doesn't really talk about what that combination of assets is. So the markets are being distrusting there. I think what we're seeing is a very normal cleaning of the crypto house, as it were, and the markets, separating wheat from the chaff. And that is something that's very normal, right? We saw this in 2000 with the dot-com bubble bursting, and that doesn't mean we don't have the internet today, right? We have a healthier and better internet today. And so we'll have a healthier and better crypto economy, as it were, going forward.
Now let's talk about Web3 for a bit. It's being billed by some as the future of the internet. What exactly is it?
Yeah, look, Web3 is an idealistic recasting of what the internet is and how it works. Right today, we're in Web2, and Web2 is essentially, a dozen or so global hyperscaler platforms, right? The names: Google, Baidu, Alibaba, Facebook, Amazon, and so on and so forth. And they're essentially huge platforms with massive compute power and server centers, right? All clustered around artificial intelligence. And we are all tethered to those centralized platforms. If you imagine one of these science fiction movies where we're all tethered to a big brain, we suck out of it what we want: information, transactions, services, and it sucks the data out of us, and then it sells the data to advertisers to make money. Oversimplified, right? But as opposed to that vision, now picture, a train going by, right? Or, I don't know if you've ever been in one of those sushi restaurants where you have an artificial river with sushi boats going by, right? And you essentially dip into the sushi boats as you like, or you look into the train carts as they go by and you pick stuff, you put stuff in, right? It's all governed by smart contracts, And so it is much more of a dipping into the flow, peer to peer, as it were, than it is sort of one giant platform that monetizes us. So it's a more democratized, bite-sized version of Web 2.0. That's what Web 3.0 is. And the idea is that we have more ways of self-actuating, having a voice, right? Having agency respected, fewer privacy problems, because this is governed more as a peer-to-peer kind of model. Very, very promising, potentially the next evolution of the internet, but we're probably going to see a healthy mix of both decentralized Web3 and centralized Web2 infrastructure going forward over the next 10 years.
And finally, Elon Musk and Twitter. So much back and forth going on. Is the deal going through or not?
No, that's a good question. My hunch is it probably goes through. This may just be the dance that he is doing to now get a bit of a discount on the deal now that the NASDAQ has dropped substantially. Tech stocks have taken a beating. He might, and his bankers might be feeling like they're overpaying for the deal, But, frankly, this also goes back to him not having done due diligence, right? He's a brilliant engineering mind, right? But fixing engineering problems and tweeting a lot does not replace due diligence, right? He could have done due diligence and figured out that this number of 5% of all daily active users actually being bots and not real people being much higher, right? He could have found that out in due diligence. It's a tricky topic because, there are some bots that are rightfully on Twitter, right? Like automated bots that place news headlines, for instance, that's totally legitimate, right? Versus bots that pretend to be people. And so that has now created a lot of uncertainty because advertisers don't know what kind of eyeballs they're paying for. Users are uncertain about their experience on Twitter. And of course, he's looking at a lot more work sorting out what's what. So I think this is yielding a renegotiation of that deal. I think both sides are still in it, hopefully to close it. And we'll see which way it's going to shake out.
Dr. Olaf Grote with UC Berkeley's Haas School of Business, thanks so much for joining me today.
Always fun. Thanks for having me.